Hello. Now let's look at a problem and see how that kind of a purchase discount and purchase return would be accounted for under a perpetual inventory system. Let's take, for example, on November the 1st, Bicycle Store. Bicycle Store here is a merchandising business, probably a retailer. We buy bicycles from manufacturers or wholesalers of bicycles and then turn around and sell them to customers. Bicycle Store on November the 1st buys some inventory. Let's say they buy 20 bicycles from some manufacturer or supplier and pay a price of $100 each on terms of $210 net 30. Meaning that we're buying these bicycles and not paying cash for them immediately, but instead we're buying them on account, and the supplier is offering us a discount if we pay on that account early. In fact, a 2% discount if we pay within 10 days. Otherwise, we'll have to pay the full amount within 30 days of the date of purchase. 2 days later, also returns one of these bikes because it's defective, returning it to the manufacturer for credit on our account. Then on November the 9th, pays the balance due net of the discount. Let's go ahead and look at the kind of entries that would be made, and we're going to be doing it manually here. Would have to account for these transactions likewise by either increasing or decreasing inventory for the account of the purchase, less any discounts or returns. So let's go ahead and look at the kinds of entries, doing it here manually. The entry on the 1st, when Bicycle Store actually buys the inventory, would be a debit to inventory for $2,000. We're buying 20 bikes, and the cost of the bikes, purchase price, is $100 per bike. And we credit accounts payable because we're purchasing them on account. This is the entry 2 days later, when in fact we discover that one of the bicycles really didn't meet our standards, it was defective, and therefore return it to our supplier. In this particular case, we're simply reversing our previous purchase entry by the one unit that we're returning to the supplier. We do that by simply debiting accounts payable for $100 and crediting inventory for $100. Now this should make perfect sense. In this case, we really haven't purchased 20 units because we're returning one to our supplier. We've only really purchased 19 units. And we only really owe $1,900. And so we do need to reduce accounts payable by $100. Now you remember that the supplier said that they would give us credit on our account. We're not crediting our account here, or at least accounts payable. But what the supplier really meant was that they were crediting on their books accounts receivable from us. For us, we are going to be debiting accounts payable. From our perspective, we don't owe them as much. And from their perspective, they're not going to collect as much from us. So we're going to debit accounts payable for the one unit we return because we're not going to pay them $2,000. We're only going to pay them $1,900 for 19 bikes. And the credit also has to be to inventory because we no longer have 20 bikes. We've just returned one to the supplier. So we need to reduce inventory by one bike at its cost. I mean, when we were selling inventory and a customer that we had sold inventory to returned it to it, we used an account that I recall that sounded like sales returns and allowances. Maybe we should use some account here called purchase returns. Well, what kind of an account would that be, I suppose? Since in fact we do need to reduce inventory, because we don't have 20 units, we only have 19, I suppose what we would do, if we were going to use some account called purchase return and credit it to reflect the reduction of inventory, it would really effectively be, I guess, a contra inventory account, a contra asset or a reduction of the asset or a reduction of the inventory account. However, under a perpetual inventory accounting system, where we want to account for inventory flows, every inflow and every outflow, directly in the general ledger and the corresponding subsidiary ledger, keeping track of every kind of inventory, inflow and outflow, it doesn't really make any sense or doesn't seem to be useful to me to use some kind of a contra asset account. We need to make this entry for the reduction of inventory directly to our inventory to show the perpetual running balance in that inventory. And therefore, we're simply going to credit inventory if we return some of it to the original supplier. Now, let's look at the next transaction that took place. On November the 9th, which was within the discount period, the 10-day discount period allowed by our supplier, we actually paid off the account, net of the discount. We decided to do this because a 2% discount is a very, very good deal. And so we want to take advantage of this discount. A 2% discount on an obligation of $1,900 amounts to $38 of discount. Now again, we're only going to pay $1,900, or at least that's our obligation at this point in time, because we've returned one of the units. So our discount is on the remaining or net balance of the accounts payable, or $1,900, and a 2% discount is $38. As a result, when we cut a check to our supplier, we're not going to cut a check to the supplier for $1,900, but we're going to take the discount. And therefore, the check will be $1,862, which is $1,900 minus the amount of the discount we're taking. Or another way that you could have calculated that would have been to say, we're going to pay 98% of the amount that's obligated because we're taking a 2% discount. And 98% of $1,900 is $1,862. That is the credit to cash. We are paying off our full obligation of $1,900, even though we're paying it off at less than $1,900 after having taken the discount. We don't owe them anymore. And since we have a balance on our books of accounts payable of $1,900, we're going to debit accounts payable for the full $1,900, even though we're only distributing cash of $1,862. The question is how would we account for this difference, which is looking at debits must always equal credits, means that we must have, therefore, somewhere or somehow account for $38 of credit in this transaction. The question is what is that? What it is a reduction in the cost of our inventory. The inventory really didn't cost us $100 a unit. The cost of the inventory here was actually, well, on a per unit basis after the discount, was really $98 a unit. But we've recorded the inventory purchased at $100 a unit. So if we're going to keep track not only of the number of units of inventory that we purchased, but also the cost of that inventory, its historical cost to us, what we're going to need to do is reduce our inventory by the $38 amount of the discount. This isn't the number of units, it's the cost of the inventory that needs to be reduced from the inventory account. But this is a little different here because we're trying to maintain a perpetual running inventory balance. Again, we're not the customer, we are not selling goods to a customer. In this particular case, we're actually the customer purchasing inventory from a supplier. It's a little bit different in terms of our perspective. And the way we're going to account for it is, well, we're not going to use some purchase discount account. If we use purchase discount, what kind of an account would it be for that credit of $38? Well, the purpose of that purchase discount would be to reduce the balance of our inventory because, in fact, the cost of the inventory is less than we had originally anticipated, given that we've taken the discount. So if we did use a purchase discount account to reflect this credit for $38, the account would simply be a contra inventory account, a reduction of inventory, contra asset account. But in this particular case, since we're going to account for the inventory perpetually, let's just make it directly to the inventory account, updating the general ledger and the subsidiary ledger so that we're keeping not only a running total of how many units we have, but what their cost was to us. This is the point I'm trying to make. The accounting for inventory perpetually requires accounting for the inflow and outflow of the number of units and any increases or decreases in the cost of those units. Again, the true cost per unit of these bicycles, well, we really purchased 20 bicycles at $100 each. But the $100 per unit cost was actually, that didn't come true. The true cost to us was $98 per unit. And therefore, after returning 1 unit, our true inventory balance of these bicycles purchased in this transaction were 19 units, and their ultimate cost to us was $98 each, for a total of $1,862 should be the balance in our inventory account in the general ledger and also in our subsidiary ledger account for that specific kind of bicycle. Now let's look at the inventory transactions that we've just recorded, posting them to really a general ledger inventory account. The original purchase showed a debit to inventory of $2,000 when we made the original purchase of 20 units at $100 each. Then we returned 1 unit, and I suggested that we should simply credit inventory for $100 for the 1 unit being returned to the supplier. And then when we took advantage of the discount, I suggested that $38 credit that reflects the amount of the discount, 2% on the full $1,900 amount due, or $38, was actually a reduction in the cost of that inventory, and I suggested that we simply credit that directly to inventory. If in fact we had made those entries, you will see that the ending running balance now in the inventory account would be $1,862. That's what it should be, because we ultimately only purchased 19 units and we only paid $98 per unit. So what I'm suggesting here is that when we're operating a perpetual inventory system, any returns of inventory to suppliers or discounts taken because we're paying off accounts payable early and able to take some kind of a discount that had been previously offered will be reflected directly and perpetually in the inventory account, leaving us with a running balance that shows the number of units on hand and their actual cost.